All right, stop scrolling for a second because something just happened in silver that you really need to understand. In the last 48 hours, silver dropped 37%. 37%. Roughly $1.4 trillion in market value didn't slowly leak out. It vanished. And now JPMorgan is out, warning that silver could fall back toward $50 an ounce, which would be another roughly 50% down from the recent highs near 120. That's not some distant theory. That's a live warning right now, and if you stay with me, I'm going to show you exactly why this happened, how to recognize this setup before it breaks, and how not to get blindsided the next time a market goes parabolic. Because here's the thing, this wasn't random, this was mechanical. And if you're holding silver right now, or if you're watching precious metals, or if you're just trying to understand how markets actually work when they get stretched, you need to hear this. Before I explain what actually caused this move, let me teach you something most people don't really understand about markets like silver. Price doesn't move on belief, it moves on positioning and leverage. And I know that sounds abstract, so let me make it concrete. Think of the market like a crowded elevator. As long as everyone stays calm, it works fine. But when it gets packed shoulder to shoulder and someone panics, the doors don't just open slowly. People rush out all at once. That's leverage. Silver isn't just a metal, it's a leverage playground. Futures, options, margin accounts, all stacked on top of each other. When price accelerates too fast, it doesn't make the market stronger. It makes it fragile. And fragility is what breaks things, not bad headlines. Now here's what you need to understand about how leverage actually works in commodity markets. When you buy a silver futures contract, you're not putting up the full value. You're putting up maybe 10, maybe 15% as margin. That means if silver moves 5% against you, you're not down 5% on your total capital. You could be down 30, 40, maybe 50% of what you actually deposited. So when price is climbing, everyone feels like a genius. But when it reverses, that same leverage that amplified your gains on the way up absolutely crushes you on the way down. And here's the part people forget. Exchanges don't just sit there and let this run wild. They have risk departments. When volatility spikes, when open interest gets too concentrated, they raise margin requirements, sometimes overnight. So a trader who went to bed fine wakes up needing to post 50% more cash just to keep the same position open. Some can post it, a lot can't. And when they can't, they have to sell. Not because they stopped believing in silver, because they ran out of cash. So what does that tell us? It tells us that in leveraged markets, price action creates its own feedback loop. Rising prices pull in more speculators. More speculators create more leverage. More leverage creates more fragility. And when something cracks, it doesn't crack slowly. It cracks fast. If this is making sense so far, drop a comment below and let me know if you've ever been caught in a move like this. Because I think a lot of people watching have experienced some version of this pain, and it's worth talking about honestly. Now here's what's actually happening under the hood with this silver move. Silver was up roughly 260% year over year. That's not normal price discovery, that's a parabolic move. When you get that kind of vertical rally, you pull in a very specific type of market participant. You pull in momentum funds who don't care about silver fundamentals. You pull in short-term speculators who are just trading the chart. You pull in retail traders who see the breakout and think they're getting in early when really they're getting in late. None of these people are there for industrial demand. None of them are there for monetary theory. They're there because the line is going up, and as long as it keeps going up, they keep buying. But here's what happens when you stack that much speculative interest on top of each other. As price climbs, exchanges tighten margin requirements. I mentioned this earlier, but let me walk through the actual sequence because this is critical. Let's say silver is at $90 and you're holding 10 futures contracts. Your margin requirement might be, $80,000. Then silver runs to 110. The exchange sees volatility expanding. They raise margin requirements 20%. Now you need $96,000 to hold the exact same position. If you don't have that extra $16,000 sitting in cash, you've got two choices. Liquidate some contracts or get margin called and have the broker liquidate for you. Either way, you're selling. And when you sell, that pushes price lower. When price goes lower, more people hit their margin thresholds. They sell. Price drops more. More margin calls, more forced selling. It's a cascade. Not emotional, mechanical. And here's where it gets really dangerous. When futures selling accelerates, liquidity thins out. The bids that were there at 115 disappear. The bids at 110 vanish. Market makers step back because volatility is too high to price risk. So now you've got sell orders hitting a market with almost no buyers. That's how you get gaps. That's how you get a 37% drawdown in 2 days. It's not that silver became worth 37% less as an asset. It's that the market structure couldn't handle the volume of forced liquidations. The plumbing broke. But here's the part that should make you nervous if you're not paying attention. These moves don't stop because something feels cheap. They don't stop because the fundamentals are still intact. They stop when forced selling is exhausted. Until then, gravity does the work. So, if you're sitting there thinking, well, silver's down 37%, it's got to bounce maybe. Or maybe there's another wave of margin calls coming. Maybe there's another leg of leverage that hasn't unwound yet. You don't know, and that's the point. In a forced liquidation event, bottoms are made by exhaustion, not by value. Now let me show you what very few people are talking about. This isn't just about futures, it's about the options market too. When silver was climbing, call options were getting bought aggressively. Dealers who sold those calls had to hedge by buying futures. That buying pushed price higher. Higher prices made those calls more valuable. Dealers had to buy more futures to stay hedged. It's a gamma squeeze in reverse when it unwinds. As price falls, those call options lose value fast. Dealers don't need as much futures exposure to hedge, so they sell futures. That selling pushes price lower. Call options lose more value. Dealers sell more futures. It's another feedback loop running in the opposite direction. And when you combine the margin call cascade with the options unwind, you get moves that feel impossible. But they're not impossible. They're just mechanical. And here's what ties it all together. Nothing broke in the silver story. Industrial demand didn't vanish overnight. Monetary policy didn't flip in a weekend. There's no new mine production flooding the market. What broke was the leverage stack, the structure, the positioning. And when positioning breaks in a leveraged market, price can move in ways that seem completely disconnected from the underlying asset. That's the lesson here. That's what you have to understand if you're going to survive markets like this. Now, this isn't new. This is the exact same playbook silver has followed before, and I want to show you the pattern because it's painfully consistent. In the late 1970s, when the Hunt brothers were accumulating silver, price ran from about $6 an ounce all the way up to $50 by January 1980. That's more than an 800% move. Everyone thought it was going to 100. It felt inevitable. Then what happened? Exchanges raised margin requirements. Forced liquidation started, and silver dropped from $50 back to around $10 within months. Roughly 50% of the entire move was retraced mid-cycle before it eventually tried to stabilize. Same mechanics, parabolic rise, crowded positioning, margin pressure, violent mean reversion. Fast forward to 2011. Silver surged from around $18 at the start of the year to nearly $50 by late April. Almost a 280% move in 4 months. Retail investors were piling in. Sentiment was euphoric. Then exchanges hiked margin requirements multiple times in 1 week. Forced selling kicked in, and silver collapsed about 45% over the next few months, dropping back into the low 30s and eventually into the 20s. Every time this happens, the narrative feels unique. In the 70s, it was the Hunts cornering the market. In 2011, it was fears about the dollar and quantitative easing. Today, it's industrial demand and geopolitical risk. But when you zoom out, the pattern is the same. Parabolic rise, excessive speculation, leverage builds, margin tightens, cascade starts. The larger story isn't that silver is broken. It's that markets punish excess before they reward patience. And here's what's interesting when you compare this move to those historical examples. The speed is actually similar. In 2011, the peak to trough decline took about 4 months to play out fully. This current move happened faster, but the initial shock was comparable. 37% in 2 days versus 45% over weeks. The mechanisms are the same, even if the timeline compressed. And if history is any guide, these moves don't just bounce back immediately. There's usually a period of volatility, a retest of lows, a base building process. It's messy. It's painful for people who are holding. But it's also how markets clear out the excess and eventually find a sustainable level. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. You might be thinking, is this manipulation? Is this JPMorgan talking their book? Is this some coordinated attack by bullion banks to shake out retail investors before they let it run again? And look, I'll be honest with you, I can't rule out that there are players with large positions who benefit from volatility. I can't rule out that some entities might have positioned for this. But here's the thing, big banks don't need to manipulate markets that are already over-levered. Gravity does it for them. When you've got speculative positioning at extremes, when you've got margin ratios stretched, when you've got options exposure that needs to be hedged dynamically, the market structure itself is fragile. All it takes is a spark. Could that spark be intentional? Maybe. But it doesn't actually matter. Could silver bounce tomorrow? Absolutely. Markets overshoot in both directions. Could this JPMorgan warning end up being early or imperfect? Sure. Forecasts are just forecasts. They're not certainties. Could there be physical demand that eventually overrides the paper market dynamics? Yes, that's possible too. But focusing on villains misses the real signal. The signal is volatility. The signal is leverage. The signal is liquidity. Those are things you can observe. Those are things you can measure. Those are things you can control your response to. That's what keeps you alive in markets. Not trying to figure out who's pulling strings behind the curtain, but understanding the mechanics that are playing out in front of you. There are probably 3 types of people watching this right now, and I want to speak to each of you directly because your situation is different and the advice has to be different. The first type is the long-term silver believer. You've been stacking for years, maybe decades. You see silver as real money. You see it as insurance against currency debasement. You're not trading this. You're holding it. And every drop is just noise to you. That's fair. I respect that perspective. But even then, timing matters. You don't need to be first. You don't need to buy every dip on the way down. If this is a deleveraging event, and I think it is, there's going to be a better entry point than trying to catch a falling knife right now. Let the dust settle. Let the forced sellers finish. Let volatility contract. You can still be a long-term believer and wait for a more stable structure before you add to your position. Patience is a form of discipline, not a lack of conviction. The second type is the recent buyer who chased the breakout. Maybe you got in at 100, maybe 110, maybe 115, and now you're sitting on a massive loss in a very short period of time. If that's you, I get it. Momentum works until it doesn't. And when it reverses hard. Your job now isn't hope. It's not waiting for it to come back so you can break even. Your job is risk management. Ask yourself honestly, if you didn't already own this position, would you buy it here? If the answer is no, that tells you something. Survival comes first. Protecting capital comes first. You can always re-enter later when the structure improves. But if you let a 37% loss turn into a 60% loss because you're anchored to where you bought it, that's ego, not strategy. Be honest with yourself about what you can afford to lose and what your actual edge is in this market right now. The third type is the observer. You're watching, you're learning. You didn't get caught in this, and you're waiting for opportunity. For you, patience is your edge. Let volatility burn itself out. Let price stabilize. Let the market show you that forced selling is done. You don't get extra points for buying the exact bottom. You get points for entering when the risk reward is actually in your favor. And right now, with margin calls potentially still unwinding, with JPMorgan out warning of further downside, with volatility at extremes, this isn't a low-risk entry. It might turn into one. But it's not there yet. So watch, learn, stay patient. The universal principle for all 3 of you, no matter where you are, is this: don't fight forced selling, ever. You will lose. So here's what I want you to answer in the comments. Which type are you? Are you holding long-term and just riding this out? Did you get caught in the move and you're figuring out your next step? Or are you watching and waiting for your opportunity? Let me know, because I think the conversation in the comments is going to be just as valuable as the video itself. Now here's where I stand. I'm not bearish on silver long-term, and I'm definitely not panicking. I think there are legitimate fundamental reasons why silver could be higher over the next several years. Industrial demand for solar, for electric vehicles, for electronics, that's real. Supply constraints are real. Currency concerns are real. But I'm also not pretending this move was random. This was mechanical. This was a leverage unwind. And until that process is complete, fundamentals take a back seat. Let me tell you what I'm personally watching. First, I'm watching whether silver can stabilize in the $95 to $100 zone without expanding volatility. If it can hold there, build a base, tighten the range, that would tell me the initial forced selling is done. If it breaks below 95 on increasing volume, that tells me there's another leg down still coming. Second, I'm watching whether a deeper deleveraging toward 70 to 80 brings volume exhaustion instead of acceleration. What I mean by that is, if we get down to 70 and volume is spiking, that's more forced selling. That's bad. If we get to 70 and volume is drying up, sellers are exhausted. That could be a washout bottom. That's the kind of structure you want to see before you step in. Third, I'm monitoring physical premiums. If this is purely a paper market unwind, physical premiums should cool off or stay stable. If premiums explode, that tells you there's stress between paper and physical markets, and that's a different dynamic entirely. Stress shows up there first. Based on my analysis, this move was structural, not emotional. It wasn't driven by a fundamental change in the silver story. It was driven by excessive leverage meeting tighter margin requirements and triggering a cascade of forced liquidations. The fundamental picture hasn't changed as much as the speculative structure has. Industrial demand is still growing, mine supply is still constrained, central banks are still holding rates in uncertain territory, but none of that matters when margin clerks are making the calls. If history rhymes, and I think it does, silver eventually finds its footing. It builds a base. It clears out the weak hands and the over-levered accounts. And then, maybe months from now, it resumes a more sustainable move higher. But it's not going to do that before it teaches one more hard lesson. And that lesson is that leverage cuts both ways. I'm not a financial advisor. This is not financial advice. I'm not telling you to buy silver. I'm not telling you to sell silver. Do your own research. Understand your own risk tolerance. Make decisions based on your own situation, not on what some voice on the internet tells you to do. If you made it this far, you're the kind of person who thinks critically, who wants to understand how things actually work, not just what to buy. That mentality will serve you well. It'll keep you in the game when other people get shaken out. It'll help you recognize these patterns the next time they show up, because they will show up again. Maybe not in silver, maybe in crypto, maybe in tech stocks, maybe in something we're not even thinking about yet. But the mechanics are always the same: leverage, positioning, forced liquidation, mean reversion. If you found this valuable, share it with someone who needs to hear it. Hit the subscribe button if you want more breakdowns like this, and stay ahead of the news by understanding the structure, not just the headlines. Stay sharp out there, think critically, verify everything, and make decisions from strength, not speed.